Good morning, everyone, and uh, thank you so much, guys, for making time. And I couldn't have asked for a better panel than this. Such diverse speakers, from growth stage to late stage to LP turned investors. So, let's have a huge round of applause for all the speakers here, guys. Uh, in India, late stage PE investing, we can't slice it in one way. There are a lot of layers. I've been covering this for 17 years and I've really seen the market grow. We have seen two cycles by now. So the 2010 cycle and now what we're seeing. So it's pretty interesting how more than 75 billion of investments have gone into growth as well as late stage investing in the last 10 years. And there is more to be invested. So, let us first start, from the deal pipeline. Where are the deals? This is a question we often ask investors in our private conversations. Where is the deal flow coming from? Especially for growth and late stage private equity investors, because, uh, the funnel gets narrower by the time deals reach them. So first up, Rohan, KKR has been investing across the spectrum. You have the ability to write a 50 million check to write up to $1 billion. So where is the deal flow coming for KKR? What are the kind of deals? What are the sectors that you're looking at?
So I think, just at the start, the market today, there's it's a very favorable market that we're all investing in. I think there's very strong drivers, which people have already spoken about. From a KKR standpoint, there are a couple of themes that we focus on, and like you said, we have the ability to invest in these themes, across a range of check sizes. So I think the first theme that we really focus on, and we're focused on in India, is this consumption upgradation theme. So just given the favorable demographic that India is in the middle of and is likely to continue to be in that phase for quite a few years to come, you're seeing a range of consumption upgrades across sectors, from healthcare, financial services, consumer. So I think that's a big theme we're all focused on. There's also this theme on, just globally competitive export industries. So in tech services, pharma, increasingly in manufacturing, Indian companies are already global champions and they have the potential to further consolidate their position as global leaders. So I think that's another theme that we are focused on, and we are seeing a lot of opportunities across these sectors that I mentioned. And I think the third theme, which kind of cuts across sectors, is this whole phenomenon of generational transition that you're seeing in India. Private equity, I think, as an asset class in India has become a lot more mature. Entrepreneurs and founders now understand the type of capital private equity represents. And I think PE capital can be a great ally for families which are going through or thinking through succession, thinking through generational transition. If they want to bring in a partner who is also long-term oriented, who can help professionalize the business, bring in talent, be aligned in terms of outcomes, I think PE as an asset class is very well positioned to play that role. And we're seeing a lot of opportunities across sectors as founders are looking to think through succession issues and bring in a partner who can sit on the same side of the table and bring in global best practices to take the business to the next level.
Right, that is interesting. Gopal, if you can jump in here and talk about the kind of deal flow that you're seeing, because clearly for a fund like yours, which plays into this very sweet spot of growth investing, a lot of your funnel, I am sure, is tech investments, while a lot of late stage investors can afford to look at non-tech investments. For you, a large part is tech investments, and how is the deal flow from that sector?
Yeah, so we are investing at, let's say, from a revenue perspective, 10 million to 100 million. Look at companies that want to be 100 million and are at the $10 million stage. And this, the supply side of deals has completely changed over the last 10 years. And I was just saying this, that until 10 years ago, the typical entrepreneur we would meet would be bootstrapped. And today, the typical entrepreneur we meet has already spent time in the venture capital ecosystem. There are about 11 to 12,000 startups that we have identified. We have a coverage funnel of about 1,000 companies. And from these 1,000 companies, we are hoping to make our next 10 investments. 80 to 90% of the companies that we invest in have a prior investor in them. So there are a lot of companies to look at, and theoretically there's an opportunity to cherry pick, but it's easier said than done.
Right. Also, the critic that, these tech investments often invite is the kind of valuations, right? And Sudhir, your firm has been, investing in traditional investments and, where you've been very mindful of the kind of companies that you pick. If you can talk about the deal flow at your end, where, backstage you were telling me there are a lot of these non-tech deals that you're looking at currently.
Yeah, I think the fact that the market is quite deep and wide is what makes India really attractive for a country-focused fund like us. You can really think of investing not as India is not a thematic for a short period of time. It's really now you think about what is the right portfolio that you create for India investment. And there is, each of the sector offers that opportunity, whether it is consumer, healthcare, now even manufacturing coming back, tech and so on. And I would say that apart from these, the transition that is happening for someone like us who does both growth and control, the ownership transition that is happening, all of that now really allows you to think of creating a portfolio of investment rather than say that in this kind of vintage I'm seeing more tech deals and it will be largely tech, and we I think we can follow that discipline a lot more, and that's the attractiveness that we see in India across, I think what Rohan said, each of those themes are extremely relevant, as all of us know in this audience, whether it is consumer, the pharma side, whether it is financial services. I think each of them give us a significant investment opportunity to invest into the country, and really meaningful entrepreneurs. I think what's also matured in the country is that the entire ecosystem from the VC and the early stage also is throwing up deals. So many of our transactions, when you start looking even at the 100 million, I'm sure Shweta and some of them will be looking at even larger, but even at the $100 million deal, you see an ability to do a mix of secondary and primary, which takes you to that. And that's because the entire ecosystem has been supporting entrepreneurs all the way up. And that pipeline is what is kind of growing. And I would kind of, the huge desire for all of us is that pipeline should be even larger, because that's what keeps, as you were asking, valuations under check, etc. If the supply of good quality assets increases, because the demand for money coming in is increasing so much that what is required is to have a good supply of investments coming up. And that's really beginning to happen. You see the number of funds which are set up catering to a level that is, say, $100 million, $200 million fund, etc., is increasing at a really fast clip. You saw in the last presentation that was made as well, the fundraising momentum. So I think overall that the ecosystem is maturing and we all see reasonable deal flows.
Right, and clearly the ecosystem has matured in the way opportunities are presenting. And Shweta, I would want you to bring in here, where Advent sits, you do these large buyouts, and also you've been doing platform deals. So there's this always dilemma that the founder has of build versus buy. And for Advent, you've been experimenting with platform deals. So if you can briefly talk about, the late stage buyouts, as well as, the reason why Advent chose to do platform deals.
So I mean, two parts to your question. So I'll talk about late stage buyouts, and I think that's a market that has definitely evolved meaningfully in the last 10 years, but I would say even more so in the last 5 to 7 years. And there are a few themes which have played into it, right? One big one is this whole founder succession. And you see it in actually various ways. It's not only that I don't have a successor, it could be I have a successor who's not interested in doing the business, sometimes we found sort of even the founders being quite realistic about whether my successor can genuinely take the business to the next level. And if not, am I sort of better off selling the business and moving on in life? Or there are multiple people in the family involved, so rather than result in a future conflict, separate it out and let people, take the money and decide what they want to do in life. So that's been one big reason why we've seen a lot of, buyouts coming up over the last 5-7 years. Second one is, of course, I wouldn't say the companies are not distressed, but the founders get distressed because of investments in other sectors, right? Real estate, power, so whether it was Crompton that came out of it, DFM, where the founder had invested behind some real estate assets and needed monetization, Eureka Forbes, where the family required some capital for the immediate debt repayment requirements, right? So a lot of the buyouts came out from one, succession issues and two, sort of distress. What we didn't see, what we thought we will see is these large business houses divesting some of their non-core assets. So that theme is one that hasn't still played out too much in India. But I think that, you were seeing a very good evolution of the late stage buyout market from where we started at ICICI Venture, 17, 18 years back and did the first buyout, right? I think there's enough to keep all of us more than busy, I would say, even though competition has been continuously increasing in the private equity market. Platform, I guess, is just another way of playing the buyout market. So, whether it is the API platform we've created or packaging to some extent where we've done a lot of, buy and build as well. In many sectors, there is a very, large number of companies and a consolidation opportunity, but there's no single large asset, right? And that's where, we've picked some of those themes, like the whole API theme that we picked now almost 3 years back, where China plus one was an interesting one, overarching theme we wanted to play. Within that, we saw APIs in a very, very interesting place. And we bought the first asset, knowing that we can really build off that. And from then on, we bought 2 more assets in that platform. And as we have announced even in the public markets, eventually the idea is to merge that with a listed company that we recently bought, which is Suvain Pharma, to create, I would say, one of the largest CDMO plus API players in the country, right? And that's just because you have a very large pool of assets available, but nothing is of individual scale. So can we become the consolidators and build a scale company in the API and the CDMO space? That was the idea there, or even in the innerwear space or in the packaging space, which we used more of the build strategy.
Right, that's interesting. Ashish, Bain has been, it has recently raised this new Asia fund, and, you're gearing up to increase your pace of investments in India, and platform is something that, even Bain is interested. What are the opportunities that you are looking at doing, in that large spectrum?
Sure. So look, I think it's an interesting archetype of deals that are available in the market, and it is one way that private equity funds, to your point, have entered highly fragmented industries and been able to create, core assets that are high quality. We think of platforms, along a whole spectrum. So you've got the large platforms where, for example, we invested in a data center business in Southeast Asia, which we then brought to India, China, and is now, cumulatively the largest data center platform in Asia. That's one extreme, where you pull together a bunch of scale assets and you build a portfolio that collectively is much larger. I think you can also think of platforms, and you've seen this a lot in IT services. If I look at our journey at Genpact, Brilio, Quest, where tuck-ins play a really important role. And I think in many of these industries, you find there's a lot of strategic rationale to doing smaller tuck-in M&As. And along the way, you either acquire a customer, you acquire a capability, and again, you're taking the core business that you've invested in and making it much stronger. That is a much more prolific way to build out a platform, and we've done that more extensively. I think the first one, you do it in a very selective way. And I'd say there's a halfway house, and Axis is a good example where we acquired Citibank, which was not a small tuck-in acquisition, but it was meaningful enough and it was very strategic and it gave us a new set of capabilities. So I think this notion of backing a strong player and under that strong player, either through a series of smaller or larger acquisitions, building a greater whole is an interesting theme in India. As with everything, there has to be a strong strategic rationale to do it. I think the market is increasingly smart enough to discount businesses that are just a collection of quickly, pulled together assets. I think that game, is not really sustainable. I also think we've learned over the years that it takes a lot of work to make these platform deals click and work. You've got to make sure the integration is right. You've got to have the right management team. There are growing pains. So I think you have to have the muscle to be able to digest these and to be able to guide how these platforms get built out. I think that's quite important as well.
Right, to muscle to do deals is very important. And Prakul, I would want you to come in here and, CPP has been an LP and has invested in Indian funds for so long, and then, the firm decides to, have an on-the-ground presence. So what has changed? By now it is established that India is a must-have market from, good to have. So we wouldn't want you to touch upon that, but, what is the playbook that you are trying to, establish in India?
Sure. Just by way of history a little bit, we have been investing in the market for close to 15 years. We have had an office on the ground for close to a decade, right? So this shift towards direct investing has been a very gradual shift and a very thoughtful and intentional shift, right? That's one. The second is the question that you asked as to why are we doing this. And the approach that we take is more to be a solutions provider. We started out in our very early days by being an investor in funds as a passive third-party LP in third-party funds. It was very clear back in the day that for us to be able to scale our program and also build the ability to make investment decisions at scale, we had to have the direct muscle in-house. And so that was a journey, frankly, that many of our peers charted before us, but we started to charter in scale about 15, 16 years ago. So the business that you see in India is kind of a consequence of that gradual evolution. And if you look at our portfolio in India today, which is probably $25, $26 billion Canadian of invested capital, let's call it the passive piece is a minority of that, right? So what we have built around our passive piece is our direct investing footprint, again, across my team, which is private equity, public equity, real estate, infrastructure, renewables, right? So the desire, once again, is to firstly be close to the market, deploy a team on the ground that is familiar with the market, has a direct investing muscle and skill set, and then is very close with our network of institutional partners, right? Many of whom are actually on this panel with me. And then figure out how we can be a solutions provider to folks who are seekers of capital and also to our partnership universe and bring opportunities to the table. We don't believe that the phone will ring and deals will come to us. Like, that's not the model we use. The model we use is to be very proactive in originating opportunities and seeking out opportunities to deploy capital, but then figuring out how we can intentionally bring value to the table from our large diversified global portfolio. Invariably, opportunities that we look at in India have some business model parallel or some investment thesis parallel with some asset we've looked at elsewhere globally. We think that's hugely valuable to us and also hopefully to our partner universe, and we really actively look to bring those insights to the table.
Right. It's very interesting where, we were speaking to this global investment bank, and they said that, we're talking about these India pool, where we are part of the Asia strategy right now. So we are seeing a lot of allocations being made out of, each global investor trying to, chart out their Asia strategy. But 5 years or 10 years from now, we'll see the global pools unlock, and we'll see that kind of deal flow coming into market. And Prakul, if you have a view on that, say 5 years or 10 years from now, are we really going to see flood of capital come into India, or is the market mature enough to take that?
I think you're seeing a mini deluge of capital happening right now itself. So I don't know what a flood will be beyond this, but all jokes aside, I think, look, interest in India as a market for the long term has been around, right? It has obviously fluctuated, but it has fluctuated more on the basis of what is happening globally and therefore how attractive India is on a relative basis, but increasingly so on the basis also of the fact that India is in its own right an attractive market. So I think that trend is sort of headed only in one direction. Where you see pools of capital being dedicated to Asia maybe 10 years ago as an overall region, is that going to move towards a country-focused effort? I think you'll see it for sure. There's a small and growing number of very well-established India-focused funds, and again, some of my colleagues on the panel represent those, and those have really established the credibility of India as a market, because if you can show strong performance for an India-dedicated fund, that's a huge selling point for somebody that is then looking to narrow down from an Asia platform into an India-focused effort. And a number of folks have considered this. I think you need to then also see it in the context of the relative opportunity. So is it worthwhile for the scale and the headline return that you can get, risk reward that you can get right now versus other opportunities globally? I think right now you're seeing a bit of a retrenchment, just given what's happening in North America. A lot of pools of capital are saying, look, should we just hunker down to our home markets and figure out what to do? But the longer term trend is definitely undeniable.
Right. So the longer term trend is, very, is aligned. But, Ashish, if you can talk about, say, how far are we from seeing an India, focus or India dedicated fund being raised? Because right now, for global, a firm like yours, India is part of your Asia strategy.
I mean, I think, look, to Prakul's point, I don't think there's a constraint for capital in India. I think to the extent there are investable opportunities in India, global investors are exceptionally rational, and I don't think that's historically been a constraint. I don't think going forward there'll be a constraint. If India can absorb the capital and if India can deliver returns that are within an acceptable threshold, I suspect you'll see a lot of capital flow into the market. So then the real question is, from an investor perspective, what's the best way to diversify your exposure to India, right? And you can have that diversification by saying, I'm going to pick a series of country managers. You can pick that diversification saying, I'll go in with a few regional funds. Or you can, effectively go after people that are global funds that are making that trade-off for you. I think it depends. There are certain pools of capital that prefer to choose that diversification themselves and go with country funds. There are others that want to leave it to the manager. So I suspect as the market evolves, you will have pools of capital that sort of self-select. From a Bain Capital perspective, look, we feel there's a lot of power in both the global linkage we have and the regional funds we've created. We think of investing as especially in this environment, as you've got to have really a lot of differential insight and conviction at an industry level. So we have global industry verticals, and that allows us to look at opportunities in India where we may not have invested before, but tap into our learnings at a global level to then shape an investment thesis here, right? So for us, we feel that connectivity back to the global platform is incredibly powerful. I think regionally as well, several opportunities like the data center platform that I referred to in the beginning, where you can actually do a lot if you are a regional platform with each other. And I think what we find is, again, capital will flow where, their returns can be made. But I think that benefit of having, global calibration and then regional collaboration can be quite powerful.
Right. It's very interesting that Ashish, you pointed out that a large part of that strategy would depend on the exits. 5 years, ago, if we were having this conversation, where were the exits was the biggest question. But by now that is established. Rohan, I would want you to come in here where, KKR has had phenomenal exits in the last 4-5 years, where you've seen, large trades, be it sponsor to sponsor, be it, on the strategic side. So how has, the comfort on the exit side really helped in putting incremental capital into India?
Yeah, I think, look, the ability to get a good exit at the end of the day is, if you invest in, a good business, I think you'll always find, I think, the right avenue to exit. So I don't think you can have good exits without making good investments or backing the right businesses or doing the right things when it comes to value creation. But having said that, I think the biggest story in India over the last, I would say, 4-5 years has really been, the level of maturity and depth that capital markets in India have evolved into. I think that's it's been a sea change. The data points I'm sure everyone here is aware of, but there have been very strong domestic market flows which have, deepened capital markets in India. We've had now quite a few exits which we've solely exited on the Indian capital markets, and these are large quantums of capital that we've returned through tapping the capital markets in India, which frankly, 10 years ago wasn't something that we would potentially, even think of, let alone underwrite. But I think the confidence that we've now got by having some of these exits in India through the capital markets has, I think when we now look at deals or we'll underwrite new opportunities for investment, I think that definitely plays into the risk reward that we we evaluate while making an investment. And I think that's a great sign for the ecosystem in general. I think a healthy, deep capital markets and well-functioning capital markets is important for for the whole ecosystem. And I think it augurs well that we are on that journey, and I'm sure we're still scratching the surface. So I think that's a very positive side and gives investors a lot of confidence.
Right. To that point, the capital markets have been, in that sense, very resilient. And Shweta, we've seen, it's been a secular trend in that sense where, the market is no more moved by a few FPI outflows. The market continues to be resilient and deep enough to absorb large trades. We've seen 2023, the highlight was the kind of block trades that happened, which offered a lot of PE investors, sponsors to really get an exit. So what is your sense, how comfort does a deep capital market give for a firm like Advent to get into those kind of trades?
So a lot of comfort, right? I mean, I have to say that I was a skeptic that if you buy, at least in control deals, right? If you have 100%, 70% of a company, how do you kind of sell that in the capital markets, right? But I think increasingly, starting with our own Crompton trade where we had control and we sold, of course, it was not a 70% stake, but a large, from a value terms, a large stake, right? And in control and diversify the shareholding. Now it seems like there are several examples of that, right? And that gives a lot of comfort because it opens up a, a genuine avenue of exit, whether it is control or it's a minority transaction. Earlier for minority, it was easy, control not so much. So definitely it gives you comfort. I think what you have to sign up for if you have a very large stake in a company is to give it a lot of time to be able to exit your entire stake. Because you have to do it methodically, right? You have to make sure there is no disruption, you have the right board, you have the right management team, which can take the company forward. Otherwise, it will not be good for the industry as well, right? So I think that's something that you have to be mindful of and allow 3 years, 4 years to sell down your entire stake as opposed to just, rush the moment you see sort of a buoyant capital market. At this point in time, obviously, I would say markets have almost gotten ahead of themselves. I think it is more positive than it needs to be, not backed entirely by fundamentals. But having said that, I think overall sentiment, of India for the rest of the globe within the country is positive. We are probably the most, geopolitically stable country in the relative context. There's still growth. There are, of course, pockets of higher and lower growth, but on balance, there's still growth. There's, I would say, a stable regulatory environment. All of that, bodes well for India, right? So that's reflecting in the capital markets. And there's a good and a bad side for private equity. Good is that, you can exit. Bad is that everything is more expensive than it, was. So that's tough. But it's, on balance, I would say it's good for good for everyone, I would say.
Yeah. Right. And I think, you touched upon a very important point of valuations. And Sudhir, valuation is something that, a growth stage investor like yours is very sensitive about. The kind of money that you pay affects the kind of exit or, the IRRs you're able to make. So, and again, valuation has been a secular trend in India. It's been just going upwards. To Gopal's point where, tech investments, we've seen some bit of rationalization, but in the sectors that you play, valuations have been very, secular in that sense. It's been going up. How are you, seeing and how are you working around that?
So you asked me the toughest question that is there in the panel. But that's fine. So on valuations, India has always been expensive because we have always priced in the potential of the market. And today, even more so because of India's position in the, and to some extent, geopolitics, etc., are relevant here in the sense that suddenly there is a very clear shift that India has made towards aligning with US and other markets. Therefore, there is a certain linkages that our businesses could also kind of benefit from. So people are saying that the reason why there is a optimism around manufacturing is because people believe that now probably our businesses can align with some of these markets and there is a growth potential. A lot of that gets factored in over a period of time. As private equity professionals, you are looking at companies in a certain phase of growth, where the growth potential is driven more by the management's or the entrepreneur's ability to imagine what can be there. And you are trying to buy into that and develop a conviction on whether that is possible. In a certain industry, can you have a company which grows at 50% and another company growing at 10%? Absolutely yes. Do those two companies deserve different valuations? Absolutely yes. So what is your ability to make that judgment and partner in that growth will determine whether you are able to play into that particular company at that valuation. But there is reasonable kind of conviction also to believe that while there could be periods when valuations would look slightly more expensive, these all go through cycles. But in the long run, for the foreseeable future, it is a multi-decadal growth opportunity that will continue to be discounted. So there is no reason to believe a complete collapse in valuation to levels which many other markets are. So the question really is that how do you factor in some amount of valuation deterioration and still make your investment case? And the growth opportunity allows you to make those cases. And then you kind of have, as some others were saying, there are different types of deals that you look into. Sometimes you're investing into ownership transition. Sometimes you're investing into platform creation. So in many essence, you're not really paying up the valuation, you are creating that value. And those are aspects that private equities will continue to evolve, and those skill sets that are required for private equity is continuously evolving. You kind of see that across all funds, the ability to really take some tough decisions in terms of management changes and still steady the ship and take it forward, etc., are kind of getting demonstrated more and more in the Indian context. So that the question that we keep asking, what exactly is the value creation that private equity is doing? There are enough and more examples, and those are growing across the ecosystem.
Right. So multi-decadal opportunity is what you look at. But Gopal, Sudhir said that, India has always had this growth premium, we command growth premium. A lot of your investments are, a lot of your pipeline is built into from companies that are previously funded by, say, a venture or an early stage investor. So is there a governance premium also that these kind of companies command, or lack of it? In today's day, we cannot ignore that fact. So how are you pricing those assets, and how are you working around that?
Well, there's certainly a pricing problem in the market. There's demand for capital, there's tremendous supply for capital, and this is a global problem. But globally, growth markets have seen a deal drought. That is a statistical fact. It's a little easier to solve for it at the upper end of the market because you can staple secondaries. And a typical investor who can do a $100 million deal can also do a $200 or $300 million deal. But at the lower end of growth, it's more difficult to source secondaries and staple secondaries. So, with secondaries, you can bring down the price of the deal without affecting, let's say, the price of the primary. Well, at some point of time, this has to give in. There's this new term, ZIRP cons, which is zero interest rate policy cons. It's been 11 years since the term unicorn was coined. We've seen a 14x growth in the number of unicorns. By some estimates, between a third to two-thirds of all unicorns are ZIRP cons. So as capital regains its character, certainly I think pricing power is coming back to investors. And I think even from the demand side, this waiting game will soon end. And you will see this deal drought giving way to more deals. Thank you.
Right. Clearly more deals and more exits. India has by now established that, the exits have been phenomenal. But, when we compare for global firms, the IRR returns, the INR returns have been phenomenal. But, the kind of currency, risk that they play into. So, Prakul, if you can talk about that, how are you hedging against the forex risk, because on the ground the INR returns have been phenomenal, the exits have been good, but when you compare to the kind of forex move, there's been some bit of dampening there.
Similar to many other global pools of capital, we're obviously accountable for our dollar-based, in our case, Canadian dollar-based return. We don't hedge our FX risk. That's something that is done at the top of the house. So while we obviously invest in assets that have prominently INR exposure, we think of them on a USD basis, just in terms of the underlying depreciation that one can expect over time. And I think that's a pretty common principle that other funds look at as well. And similar to other funds, we also look at export-oriented businesses where the returns are not just with an INR basis, but might actually benefit from that depreciation. The jury is out there whether that perpetually depreciating trend of the INR will continue. We don't bet on that. We don't bet against it. But at a headline level, what is available on the table in INR terms is higher than what ultimately you'll realize on a dollar basis.
Right. I think we've run out of time, but one last question, at
I'm
a time
afraid we have run out of time, so maybe
just one last question. I'll just sum up with that. Capital has become commoditized, and at this moment, it's very important, how an investor is differentiating themselves. And Ashish, if you can talk about that, say for a firm like Bain, how are you, because it's become a crowded market, how are you really differentiating yourself as an investor? And with that, we'll wrap up.
Okay, I feel nervous being the last word on the panel, but look, you're right. I think it is increasingly competitive out there. I suspect if you speak to any of us, eventually the way we think about it is it's three things that matter. In this sort of a market, you've got to have, you have to challenge conventional thinking, you have to have a differential point of view on an asset, how you're going to make money with it. But I think increasingly it's more important to be able to back that up with a real capability on what you can do when you own these businesses. We call it, our portfolio group or our value creation approach. We were a bunch of ex-consultants that got into investing, so I think that comes more natural to us. But I think that's really going to differentiate people because everyone will have insights on, industry growth, pricing, etc. But your ability under your ownership to bring that to life, I feel, will be critical. I think with that comes the need for deep partnerships. Eventually, no private equity fund can do it by themselves. So the ability for you to work closely with and form aligned partnerships with founders, promoters, really capable CEOs, I feel would be the second thing that would set apart different players. And I'd say the final thing is eventually you have to build businesses that are making a positive impact in the communities and in the countries they operate in. I know ESG is a much abused term, but eventually if you build businesses with the right governance, with the right sustainable environmental impact, I think the markets will give you a premium for it. And as we think of homes for our businesses, eventually you will get rewarded for that. So again, in a nutshell, I think all of that will hopefully allow us to compete in a more competitive world.
Great. With that, we'll end the discussion. Thank you so much, guys. You've been phenomenal.